Good afternoon, everyone. Thank you for joining us for today's webinar, where we're going to talk about year-end tax planning opportunities and essentials. Before we get started, I'm just going to go over some quick housekeeping. Everyone on today's call is muted just due to the number of people on the call. If you have any questions, please submit them using the chat or Q&A feature. You can also raise your hand and I'll unmute you if you prefer to ask your question verbally. We'll answer all of the questions at the end of the webinar, as we do have a lot of content to cover today. And the session is also being recorded, and you will receive a link to the recording within the next couple of days. Today's speakers are Barry Sunshine and Michael Gershon, who are both partners at Janover. I'm really excited to hear their ideas and perspectives on tax planning. So I'll now hand it over to Barry.
Good afternoon, everybody. Thank you for joining us on a beautiful day. This is, it's almost December, and everybody should be taking a look at their year-end tax planning, because if you don't, you may lose a lot of opportunities. And there's a lot of things to consider, a lot of things to review before the end of the year. And you do all this business and you conduct all this business and you do all this personal trading and so forth from January to December 31st. And it's a good time to look at it, to reduce your tax planning and to look at your tax things. So anyway, today's agenda is Michael and I are going to cover the Inflation Reduction Act that has a little bit of traction and not a lot of talk about it, but there's some good ideas in there. Then we're going to talk about year-end tax planning, and Michael and I have been doing it for many, many years in looking at closely held businesses and their owners, whether you're in the real estate space, you're in the commercial space, or just an individual wants to do year-end tax planning. So we're going to cover a lot of different ideas and suggestions to help you look at year-end tax planning. And then the other thing that Michael and I are going to talk about is two overlooked big tax planning ideas. And we've over the last year, we've seen a lot of clients and other businesses and other transactions where we brought this to their attention, and it's overlooked by most tax advisors and most overlooked by clients and other business people. So we bring them to the table. This is one of the ways we bring value to our clients and friends and so forth. And it ultimately puts money in your pocket by saving taxes, and it increases one's net worth. And that's what we're trying to accomplish over a long period of time. So that's the game plan, and that's what we're looking to do, and so forth. And let's get started, because we got a lot to cover. Okay, so the first slide is this Inflation Reduction Summary. Okay, it would be very difficult to talk about the Inflation Reduction Act, and there's been a tremendous amount of traction in the newspapers, TV, and in social media about the IRS funding. So the IRS funding is they increased the IRS funding by $80 billion. And a lot of conversation is, what's the IRS going to do with this money and what they're going to do? So whether you're doing year-end planning or you're just doing business as usual, some of the things that I took note on what the IRS is planning on doing is, one, they're looking to upgrade their antiquated computer system and telephone system to enhance just the way they do business. The next thing they're going to be doing is they're going to enhance what I call international tax reporting. The IRS thinks that, and the Treasury thinks that there's a lot of money to get from all this international transactions that they're not able to catch up to. They're also going to look at non-filers, and they can be able to chase and track non-filers in this digital world where there's a lot of computers and a lot of different softwares and a lot of different information being transferred electronically. They want to be able to catch on to all of these things. The other thing they're going to also do is they're going to hire more agents in all the different spaces. So what they're going to be looking for is just enhancing the number of IRS audits. I could say in all the years of practicing, I haven't seen such a low rate of IRS audits of whether it be businesses or individuals and so forth. It's just it's a little scary on how few people they audit, and they want to become better and use technology a little bit better. The other thing is they're going to also use this money for collection efforts. Okay, so what they're going to try to do is there's a lot of people that are not paying their taxes, and it takes them a fair amount of time, especially with this pandemic, about actually chasing after people who owe taxes. So to the extent that they can shorten that period of time, that shortens interest and penalties. So it gives the taxpayers and the IRS a better chance to catch up and so forth. And the other thing that they're also doing is the Treasury Department feels that there's a fair number of cryptocurrency transactions that are not being reported. And they feel that there's a lot of taxes that are not being paid on those transactions. So I think the IRS is going to go after that and so forth. And then the last thing is just going to hire more people, more agents, more people internally, more Treasury Department people writing regulations, releasing information, so we can read it and get up to date and be able to hopefully become more efficient from the IRS side and the Treasury side so they can do something. Michael, do you have anything? I mean, this is such a big topic. Do you have anything that you think the IRS is going to really do with this $80 billion?
Well, I think you hit the right points, Barry. I think the IRS, though, is going to have difficulty in staffing up and, getting 87,000 employees. They're also facing a lot of retirements in the next 5 or so years. I saw one estimate of about 51,000 employees retiring within 6 years. So by them trying to find people, and they're competing with us and the rest of the public accounting industry, private industry, I think it's going to be rough on the IRS to fully staff that 87,000 people. But I think the money going to their systems and enhancing the systems, letting them talk to each other, will go a long way in helping them to better enforcement.
I think also, yeah, I think that's 100% correct. And quite frankly, I mean, if you get a notice or you get a call, you want to call the IRS up and you call them up, you're going to be on hold for a long period of time. So just getting the people, the systems, and help the public pay their fair share of taxes. I think that's important. And I think without, it would be wrong not covering that. That's the long-term goals. Okay. The other thing that the Inflation Reduction Act, and we'll go into some of these in detail, is they're going to be talking about the 179D and the 45L tax credits. Well, I'm a big tax code junkie. A lot of people I speak to aren't. So, but Michael's going to go over 179D and the 45L tax credit in a little bit more detail. But those are good incentives out there. Also, the other thing is one of the big things that the Inflation Reduction Act did is they're looking to give larger and more credits to those who are buying new or used electric cars. And the credit, instead of being like a short-term credit, buy a car this year and you don't know next year if you buy a car, they extended this credit to the year 2023. So if you buy a car now and you pick it and you get it next year, you'll get the credit. So they're going to be we'll talk a little bit more about buying these and getting these credits. Another area that is really, really goes under the radar for a lot of businesses is the following. A lot of companies don't know it, but they have research and development costs. So these research and development expenditures, which were previously allowed to expense it. And what most companies did that, they didn't capture that if they did some type of new development or innovative in mathematics or technology or computer area, you were able to get some tax credits, and those credits would reduce your income taxes, because if you had a credit of $10,000, it actually reduced your income taxes by $10,000. What they did is, because of the pandemic, really hurt businesses, and some businesses are really being challenged for getting profits. They still want companies to invest in research and development costs. So if you can't use the credit for reducing your income taxes, they're allowing you to reduce your payroll taxes. And a lot of research and development costs are in the form of wages. So you're paying wages, and this is another way of funding your business and enhancing your business, because if you get a $20,000 or $30,000 credit, it can be applied against your payroll taxes, and you can get lower payroll taxes. So that's important. Now, the one thing that there is something out there that came into not the Inflation Reduction Act. There was a provision in an earlier tax bill that says that research and development costs, whether you take the credit or not, are no longer deductible. They have to be capitalized. And if they were US costs, you can amortize them over 5 years. And if they were, if the research was done outside the United States, it would be amortized over 15 years. Now, personally, I think they're going to repeal that. I don't have a crystal ball. Every time I use a crystal ball, it breaks. But I think that they will be repealing that, allowing a full deduction for research and development costs and expenditures. So if you do have these costs, it's a good thing to talk to your tax advisor as the best plan for these research and development costs, because if you can't use it, you may have to capitalize it if a provision doesn't change. But if you do have it, you want to make the most of it, and it may be able to capture it and harvest it against payroll tax credits or income tax credits. The other things are the premium tax credit. They're just extending it to the year 2025. And there's other two provisions which are looking to raise a lot of different tax revenues. Is a 15% corporate AMT on certain companies with profits over $1 billion. The Treasury Department does studies of the largest companies in the United States and that file income tax returns. And the tax rate for corporations, C corporations, are at a flat 21%. And they're finding some of these larger companies are not paying what they think is their fair share of taxes. So they have like a 15% corporate AMT tax for these companies. And also if they have a corporate stock buyback program, there's a 1% excise tax on this. So these are the things that are in the Inflation Reduction Act. These are all very good things if you can capitalize on it, because they'll help you save a few extra bucks for your businesses. Michael, do you have any comments on this?
Thanks, Barry. I think the only thing I do want to mention that I think the 15% corporate minimum tax might be really the first time they're looking at book income or financial statement income and basing it off of that with a few adjustments as opposed to taxable income. And I just found that an interesting part of this whole bill.
Yeah, that's right. I mean, they're just looking at companies that have large profits on their financial statements, and they're not paying much in corporate income tax. So they don't think that that's fair and equitable to the tax system. So, but that's exactly right. So now I'm going to turn it over to Michael to go over one of my favorite provisions is the section 179D.
Thank you, Barry, and thanks for that summary. Good afternoon, everyone. 179D has been in the code for a while, and it's to enhance you know, it's an incentive to provide energy efficient improvements or construction in the real estate world. And you need to provide, it provides for, the original one provided for 60 cents for 3 different units, and meaning the interior lighting, the building envelope, or the HVAC system, and you could get a total of $1.80. With the Inflation Reduction Act, you now have the opportunity for much greater deduction, up to $5 per square foot deduction, but that begins in 2023. You know, for 2022, you still have, because of inflation, up to $1.88, but starting in 2023, up to $5. Now, the $5, and that's based on a base rate of a 25% improvement in energy efficiency, and then it goes all the way up, and you can max out with 50% energy efficiency or more. What you have to look at, though, in this case, and what the IRS has done or Congress has done, they've tied prevailing wages and apprenticeship requirements to many of their new incentives in terms of these energy efficiency. So if you have prevailing wage, if you meet the prevailing wage and apprenticeship requirements, your base is going to be at $2.50 per square foot for a 25% reduction, and that'll increase by 10 cents for every percentage over 25, up to 50% for a maximum of $5. If you don't meet those requirements, though, you'll still be at 50 cents per square foot, with the ability to get up to $1 per square foot at 50% or over energy efficiency. And these are based on what the ASHRAE standard 90.1. Typically, they've changed from looking at 2 years, the standard that's 2 years before construction began. Now it's 4 years before construction ends. But one thing to note is the standards are constantly changing. However, they have to be affirmed by the Secretary of the Treasury. As of June of 22, they were still using the 2007 standard. So at some point it might get up, but if you're using 2007 standard, there's a good chance that you're going to meet the requirements and be able to take a good advantage of this. Another big thing that has changed is that under the old 179D, you're only allowed to take the deduction once, meaning that if I built the building or improved the building and I met these energy efficiency requirements, I could take my $1.88. If 5-7 years later, I did some put in additional improvements, and they met all the requirements, I was not allowed to get additional on those new improvements, take an additional deduction. Under the new law, under the new 179D, I can take that deduction every 3 taxable years on subsequent energy improvements. So if I today had put into service qualifying energy efficient building systems, I would get the deduction today. And let's say I qualify for the full $5 on the per square foot. And then I put 5 years later, I put in additional improvements that met the requirements. I can again get additional deduction under 179D. So it's a pretty powerful and valuable deduction that they have. And again, it's going towards, energy efficiency and clean energy. Heather, can we go to the chart? Next slide. So we put together this chart, which shows kind of the differences and comparisons between the new RFC section 179D, which is effective January 1 of 23, versus the old section 179D that's in effect through 12/31/22. One thing we'll talk about later is bonus depreciation. And one of the things that I'm talking about with a couple of my clients is bonus depreciation. Right now, you get 100% bonus, but you're still, so if I make improvements and I do a cost seg and I have bonus and place it in service this year, am I losing out on some section 179D deductions if I held off and put them into effect in 2023 when bonus depreciation maxes out at 80%. So there are some calculations, and that's where the planning at this time of year comes in to play and is important to run the numbers. Barry, anything to add on to 179D?
Yeah, I love 179D. That's one of my pet peeves. What I like about it is, and if you think about it, I mean, what I always like the idea of getting a tax deduction without spending money. Okay, and what I mean by that is, let's say you did a energy efficient building, and let's say it was 100,000 square feet, and it was a commercial property, and it qualified for the 179D. You could be a building owner, you could be, an architect, an engineering firm for it. And what happens is if you did this 100,000 square feet building, you would actually get next year $500,000 as a tax deduction. This year, $188,000 of a deduction, and you didn't spend any money to get it. So it's like a free tax deduction just doing the 179D, taking advantage of the 179D provision. So this is something I call it the hidden deduction. You don't have to spend money for it, so it reduces your federal effective tax rate. And it also reduces your New York State and your state taxes because it's a deduction that appears on the federal return. So this is why I like it, and as well as all the things that you outlined too, Michael.
Right. One of the things that I failed to talk about with it is who qualifies. Typically we think of the building owners, but they've expanded eligibility for designers of the buildings. So if it's a governmental building, many people know that under the old law, they looked at you, if you did some government work, it was designers of those buildings who could get the benefit of 179D because the government doesn't need it. Now they've expanded it for designers to not-for-profits, to religious organizations. They also, any not-for-profit schools. So if you do college work for public or private schools that are not-for-profit, you then can the designers can now take advantage. So I think that opens it up for a lot of the designers, architects, engineers to get the benefit of the 179D.
That's right.
Right, next, we're gonna talk about, section 45L, which is the energy efficient single and multifamily developments. And again, this is part of Congress's attempt to incentivize the building of energy efficient buildings, and this is on the residential side. So first, this is a incentive that expires periodically. And as you can see, under the new law, it's been extended. It had actually expired in 2021. The Inflation Reduction Act extended the old law to 2022 and now through 2032. Under the Inflation Reduction Act, they've increased the amount where owners the amount that owners are allowed to claim a credit for goes up from $5,000. It goes up from $2,000 per dwelling up to $5,000 per dwelling. So, again, $3,000 if you're building a residential building that has 100 units, you now have, a pretty big deduction that you or credit that you're able to get.
Mhm.
Under the old law, they limited it to low-rise developments. So this, although still nice to get for a lot of our residential developers, it wasn't a big thing. They had to be either a single home developers or low rise, less than 3 stories. Now, high rise buildings. So if you're in New York City or any other metropolitan area and you're building up multi-unit residential housing, you now will qualify for this credit. Again, very important. It reduces the cost to build and allow for new development, and again, for energy efficiency. So the 45L, which in the past has not been, in my practice, I have not seen tremendous amount of it. Now we will start seeing it because we've been talking about it with some of our residential developers who develop on, mid-rise and high-rise buildings.
Right.
Next, we're gonna talk about on the next slide is the tax credit for electric vehicles. Now, again, we all have seen it where the government wants us to all buy electric vehicles. Some states have already, stated by 2035, all vehicles sold have to be electric. So they're starting with this Inflation Reduction Act to enhance this tax credit to start getting people to look at electric vehicles. However, they have changed a couple of things. there are certain income requirements. For example, if you're over certain, I think for married filing joint returns, if you're over $300,000, you don't qualify. So they're trying to get more people who would not necessarily look to buy electric vehicles to now look at it because they have up to a $7,500 credit. Now, all manufacturers used to have a $200,000 unit cap on the number of cars, electric vehicles that would qualify for the credit. Tesla, I believe GM had already met their limits. Those have now been lifted. And so an unlimited number of cars are able to be sold by any manufacturer. But again, there are income thresholds. There are also price limits. I believe the electric cars have to be $80,000 or less. So some of the Teslas, I believe, go for over 100. Those wouldn't qualify. And then there is a stipulation that it is, assembled. The final assembly has to be in North America. So, and what that means is all the components of the car have to be put together in North America right before it goes to the dealership. And it has to be in a plant, done in a plant and everything. So again, they want to bring some of that manufacturing or assembly back to the US. Now, another piece of this is that this credit also extends somewhat to pre-owned autos that meet certain requirements, similar requirements, and that credit is limited to $4,000. So those are some of the important credits and energy efficiency credits that are in the Inflation Reduction Act. Barry, do you see the electric vehicle tax credit as being an important role with the state requirements, or bringing about legislation requiring electric vehicles in 12 years or so?
I think the genesis of these credits and expanding it and removing the 200,000 cap manufacturers, increasing the credit, extending it to pre-owned autos. I think the government, Congress, was under a lot of pressure because the price of gasoline was increasing. And they had to do something to try to control the price of gasoline. I'm sure they went to the oil country providers and told them to lower the prices to make it more affordable. But the other thing that they showed the public is if you buy an electric vehicle, you're going to get a tax credit. So they're giving the taxpayers money in their pocket to help buy these cars and pay for these little bit more expensive cars. It's good for the economy. It's good for the U.S. not relying on gasoline. And it's good also for just the environment. So I think Congress is using this as a mechanism to satisfy a lot of different requests. So that's where I see it. And I think it's only going to it's going to strengthen each year as more and more people buy electric cars. So that's where I see it going. And that's just my feeling of it.
Well, thanks, Barry. And now I'll let you take, start with some of the year-end planning for businesses.
Okay, so now we're gonna go back, now we're gonna go back to what I feel is the conventional year-end tax planning that you have to visit each year. And a lot of our clients are closely held businesses and their owners. And it's hard to separate the two from a business standpoint because most of our clients operate as pass-through entities, whether it be LLCs or subchapter S's. So any of the income that the company earns, it eventually gets on the individual's income tax returns. So what we're looking at is breaking out the business tax planning from, and we'll get into the individual tax planning a little bit later on. But the most important thing is reducing, if it makes sense, your income taxes for over a long period of time. And one of the things that Michael and I talk about regularly is when we do tax planning, it's great to do short-term planning between now and the end of the year to make sure you pay less money in April. But the best laid tax plan is to develop a long-term income tax strategy, because the more you can defer taxes, you may have to pay it later on. You may have to pay it at a lower rates later on. You may have to pay it at some other point later on, or maybe you can defer it later on. But the most important thing is for businesses, it's critical to put money in their pockets, because if you to the extent that companies have to grow, pay for higher materials, pay for more higher labor costs, attracting new people, investing in technologies, it's a lot of money to do that. And it doesn't leave much money left over for the owners. So to the extent that businesses can lower their taxes, that puts money in their pockets to help them fund this, as well as make a couple of extra bucks. So the first question I raise is, does it make sense to defer income and accelerate deductions? And the reason why this is the basic is this. So if you defer income into next year, or you can accelerate next year's expense into this year, does it still make sense to lower your taxes? Well, if you have a zero tax rate because you're operating in a losses, it may not make sense. It may make sense, it may not make sense. But what you should do is try to sit down and figure out what your tax bracket is this year, next year, and use a crystal ball what you think it's going to be the following year. And you want to move income into those lower bracket years, as well as to the extent that you can defer them to a later point in time. That's the better mechanism. And I always look at it this way. If you had let's say if you had $10,000 of taxes due, if you defer that next year, and then that following year, you defer that $10,000, and you defer that $10,000, and you deferred it for 10 years or 12 years. And if you apply an 8% interest rate on the savings on the taxes that you didn't have to pay, that ends up being far greater than the tax expense that you would have paid, or may even be greater than the amount of the deferral that you were doing. So it still makes sense from a mathematical standpoint and from a tax standpoint. So what are some of the ways that we use, some of the techniques that the tax laws allow you to do that? Well, if businesses could be on the cash basis method or the accrual basis method of accounting. And if you're on the accrual basis method of accounting, and we see a lot of companies on the accrual basis method of accounting, and the 2017 Tax Act allowed more businesses to be eligible to use the cash basis method of accounting. So that's one of the things that you should take a look at. And if you've been using the accrual basis method of accounting, and you can take advantage of this 2017 tax provision, there's an automatic change to do that. So you don't need the IRS permission, but you have to tell them that you're doing that. If you're a construction company or you're using percentage completion in all of your jobs that you're doing, the TCJA allowed you to use or broaden the completed contract of it until a later point in time. And if you had a 2-year job, and let's say, for example, you were going to have $1 million of income, if you did 50% of the job this year and 50% next year, you would be paying the taxes on that $1 million over 2 years. If you were able to use the completed contract, you may end up finding out that the job may not have been as profitable because you have higher material costs, labor costs, or just the job has just been extended due to COVID a little bit longer, so your profit may not be that large. So to the extent that you don't have to pay the taxes on that $500,000 that I said earlier, this year you could defer it to next year. There's putting money in your pocket, and eventually next year you could do the same thing. So you're rolling deferrals for a longer period of time. So one thing we tell people to do is make sure you take a look at your method of accounting of what you're doing and make sure it's efficient from a tax reporting standpoint. But more importantly, you just can't make it up. You have to use a method that's acceptable under the code and acceptable by the IRS. Now, we have a lot of landlords and building property owners, and some tenants are doing poorly and they may be behind in their rent. So if you're using the accrual basis method of accounting, you just can't say, I'm not going to record that rental income because under the lease agreement, it's a receivable and you're using the accrual basis method of accounting. So what we're saying is to the extent that you may be able to renegotiate the lease before the end of the year, or possibly maybe even use the cash basis method of accounting and change your method of accounting. So if you're not going to collect a few months of rents on tenants that are behind, again, you're not paying the taxes on that receivable that you didn't get the cash on. Continuing that if you sold a piece of property, not publicly traded securities, but to the extent that you sold some real estate or some other property, and you were collecting the principal payments over a period of time beyond the year, you can use the installment method of accounting. And you got to be careful because if you have a $5 million receivable on installment sale, you may have to pay some interest on it, but the tax savings on it is far greater than the interest that you have to pay on the deferred taxes. And the last thing is this, whether you're on the cash basis method of accounting, and cash basis method of accounting, you pay the taxes when you collect the money, or you're on the accrual basis method of accounting where you pay when you bill your customers or clients and so forth. If you just delay your November or December billing to ensure that the money comes in next year, that's a mechanism of deferring income. So those are not overlooked items, and those are really critical pieces of it. And these are some of the things that I'm talking to with clients, as we speak right now. So those are some of the things that we're doing right now. Michael, do you have any other ideas that we could do for delaying revenues at this point?
I think you've mentioned most of them that we're talking about, things that can be implemented now in the last month of the year. Some of the tactics might be a little bit more sophisticated and go out through many years. You could use, there are things that I know are out there, certain things like life insurance you can use as investment vehicles and use that, but that I think is outside the scope of this webinar right now.
That's right. So anyway, okay. So next slide, we're coming over deductions. The next one, when you start looking at deductions, the first thing is this property and depreciation on property and expensing. There's various different ways of when you do capital expenditures. For most people think that when you buy a building, you buy equipment for your manufacturing plant, that costs money out of your pocket. You may finance it, but that money out of your pocket, the question is how do you best harvest the deductions? Okay, so there's 179. We talked about 179L, but this is 179. And 179 allows small businesses to actually expense tangible personal property and some other real property costs as an expense. And it's capped at about a little bit over $1 million. It also allows you to, if you have to capitalize it and depreciate it, there's different lives to depreciate it over. But for 2022, you can take 100% bonus depreciation on it. And next year, the bonus depreciation is 80%. You're still able to depreciate the remaining 20% over the tax life of that property, but to the extent that you can take a deduction all in 1 year, the better it is. You got to be careful because accountants, when we do tax returns, we look at 179 for small businesses, and we rather take 179 than bonus, basically because for state purposes, you're able to take the 179 deduction for state purposes, but a lot of states like New York and Connecticut, New Jersey don't allow bonus, so you have to, there's a vig there on it. The other thing is we talk about when you buy a building or you have building and you have other different types of major improvements, before you even look at bonus depreciation, the basic thing is whether you have to capitalize it, okay? If you have to capitalize it, then you got into the different things. The other thing is there's cost segregation studies or repair regs out there, very, very favorable. And what that does is, if you're a building owner and you own a 10-story office building, commercial office building, and you have TI, tenant improvements for one of the floors, and it may cost you $300,000. It makes a lot of people think you have to amortize that or depreciate that over the life of the lease, but for tax purposes, it's 15 years. It may be 15 years, maybe 39 years, but let's say 15 years. What happens is under the repair regs, you can actually expense it. So what I'm doing to my building owners who own property, who are looking to negotiate leases with tenants, I'm saying to my building owners, if you pay for these tenant improvements, you can actually expense it. But if the tenant pays for it, the TI, they have to capitalize it and amortize it over 15 years or take bonus depreciation on it, and it costs them a little bit more money. So what you could do is you can actually finance those costs for the tenant, make a money on it, and it will save you taxes over and above that. So these are the things that we're talking about right now, and we're looking at this and helping our clients and bring value to them. The other things that we're talking about is we're looking at bad debts. If you're a accrual basis taxpayer that has to pick up the income, we're looking at that. And we want to make sure that these bad debts are really bad debts, not just hopeful bad debts, which aren't deductible. To the extent that you can prepay certain expenses in December and take the expense for next year and move it this year, that's fine. Retirement planning, we'll talk about that a little bit later on when we get to the individuals. But if a company doesn't have a retirement plan, there's something there to be said. And also, if you do have a retirement plan, maybe you can change it to make it more beneficial. The key thing about expenses is we want to make sure that you just can't pay or accrue expenses that may not exist. So under the tax laws, you have to have the all events test. And basically under the all events test, you have to make sure that one, the liability exists, that the liability can be reasonably determined in dollar amount, and the underlying economic performance of the services have been performed in the tax year. So, so those are the couple of things that you need to do for business expenses. And to the extent you can capitalize them, that would be great. Next slide. The other things that we need to be very aware of is I talked about the beneficials under the 2017 Tax Act. Well, it basically applies to businesses that the last 3 years average gross receipts were $27 million or less. If you have $27 million of average gross receipts or more, then you may not be able to take advantage of some of those cash basis method completed contract. Also, you're going to get subject to a business interest expense limitation. And what that does is for certain businesses, you're only allowed to deduct up to 30% of your EBITDA income for your interest expense. So if you have zero taxable income before your interest expense, and your average gross receipts are $27 million or more, you're not going to be able to deduct it this year. You're going to be able to deduct it maybe next year or the year after. The other thing is there's a 20% now for next year, there's the qualified business income deduction, which is 20%. And what that does is that reduces for qualifying businesses, it reduces your effective rate. And what I mean by that is it gives you a 20% deduction. It doesn't cost you any money. It doesn't cost you any money, but it actually reduces your effective rate from, if you're in the highest rate of 35%, it brings your effective rate down to 29.6% rate. So it doesn't cost you any money. So we want to make sure that you qualify for that. And to qualify for it, there's specified businesses and there's other businesses. Specified businesses are basically professionals or personal service businesses, but in general, but all other businesses are qualifying for it. If you're a construction company, a real estate developer, you're able to the 20% deduction on it, but you have to make sure that you have taxable income and you have to have wages as to be able to support it. The other thing that comes under that really becomes scrutiny is where your business is doing business. You may be teleworking in Nexus. You just got to figure out where you're doing business and so forth. Those are all important. So you should be addressing where you're doing businesses to the extent that you can move your business income to a lower tax state, you're saving money. So especially for the owners that don't live in a higher tax bracket. So those are the different things. The other thing is it's been getting a lot of traction over the last 2 years, which is this pass-through entity tax. A lot of the local states that we're in, New York, Connecticut, New Jersey, gets these publicly, these pass-through entity tax deduction. Let's talk about that a little bit more about that. But basically, the state, for pass-through entities, the owners who pay the taxes on the business income is capped at their state and local income tax deduction at $10,000. So if a company had $500,000 of income and it rolls to an individual's tax return, you surely bet that they're going to be subject to this $10,000 state and local income tax deduction, and they're not going to be able to deduct it more. So by making this pass-through entity tax election, it allows you or the business to deduct what would have been on the individual side to the business side. Michael, why don't we go over what states are eligible for this and so forth?
So thanks, Barry. As you can see, there are a lot of deductions, and I think the pass-through entity tax is a big one that you really have to consider, but you got to look hard at it because there's a lot of issues which states you elect into. But here, as of 2022, you have 29 states and one city, New York City, going forward, allows you to pay the tax at the entity level and passes it through to the shareholder or partner to take a credit against their own tax on the state. And that's one of the considerations. Since a lot of, I think people on this webinar are probably New York City people, one of the things, since this is new, New York City, you can only elect into the New York City PTT if you've elected into the New York State PTT. And for, 2022 only, you have until March 15th of 2023 to elect in to the New York City PTT. So that'll apply a lot to many of the S Corps. But there are rules in which this applies because of they limit, and if we go to the next slide, there are some careful considerations that we have to take into account with the PTT. You got to ask yourself, are you going to get a credit for if you're a multi-state, if you do business in multiple states, whether or not you'll get a credit on your home state for it. Some states say you only get credit for the PTT if it's substantially similar to the program in New York, let's say they'll say only substantially similar. And we know that there's been some states that are not. You also have situations where, depending upon if you have resident owners or non-resident owners, will that work out? How does that work out? How do you allocate that credit? Do owners still need to file returns in that state? And what happens then? So there are a lot of considerations here that you have to look at. You also have to be very cognizant of the timing of making an election into the PTT. And what happens if early in the year, so you're losing money, business is losing money. They decide, okay, I don't need to make the PTT, and subsequently their year turns around. They have income for the year. Are they allowed to now go back and make the PTT election? So a lot of considerations, a lot of planning that needs to go, a lot of discussion needs to be had to make sure that you're making the right elections and the elections that are going to save you. You know, overall, as Barry said, you know, this is to get the benefit, the state and local tax deduction benefit that was taken away in the TCJA. This is better than that, the state tax deduction, because it's what we consider an above the line deduction. So it goes against AGI, where we know on an individual return, some of the deductions are limited based on AGI. So that's some of the planning that has to be done with PTT. And now I'm hurrying through this only because we have some, we're coming to the end of our time, and we wanted to get into some of the individual tax planning ideas, and I'll let Barry go through these right now.
Yeah, okay, so we only have a couple more minutes, so let's spend a couple seconds on this. So basically, when we looked at the business side, now let's look at the individual side. The individual, I mean, one of the things we always talk about is compensation. That's the most heavily taxed piece because it's subject to the regular income tax rates, it's subject to payroll taxes and so forth. And same thing with self-employment income and business income. So to the extent that you can defer that type of income to later on, you're saving, again, heavily taxed income. Investment income, interest, dividends, capital gains. Dividend income, you want to make sure that you're able to take advantage of qualifying dividends, which are subject to the capital gain rates. And also, if you're trading and have a lot of stock gains and losses this year, the stock market's like just a little under 20% decrease this year. So to the extent that you have stocks underwater, meaning the fair market value is lower than its original cost, you can sell those before the end of the year to take those losses to offset the gains. And what's been in the news recently is the FTX debacle. I don't really understand it fully, but it seems like there are people that may have lost a tremendous amount of money right now on it. It appears, because it's considered personal property, we're not able to take tax deductions this year. And a lot of people are going to be surprised about that. I'm sure we're going to see more writing on it come March and April when people start seeing that. And let's talk about some deductions and passive losses. To the extent that you can accelerate deductions, I talked about a little bit before. Be careful with passive losses because you don't want to fund deductions that are going to give rise to passive losses that you can't use. The itemized deductions, try to maximize that. One strategy that I use is because a lot of people lose the SALT deduction, they're not able to itemize. So if they give away, like, let's say maybe $10,000 in charities each year, what you may want to do is bundle the $10,000 into $20,000 of charities one year, next year do zero, and the following year do 20,000. And in that way, by bundling them, you're gonna get not, instead of getting the standard deduction, which is a high floor, you're gonna be able to take the benefits of the charities that year. Next year, you'll get the higher standard deduction. So those are the different things that you do. Be careful of the excess business loss. And what that is if you have business losses greater than $524,000, which is your business losses in excess of your business income, you can't deduct the excess. It gets carried over to the following year. And if you have net operating losses, take a look at them and try to harvest them as best as you can. I think we're out of time. So we have plenty of other slides to cover, and maybe we'll do that in another webinar in the future. I don't see any questions and anything in the chat. No, I answered some of them, and Michael answered them along the way. So I really Michael and I want to thank you. Michael, do you have any last words other than?
Yeah, just if there are any questions, reach out to Barry or I. We're happy to discuss any of these in further detail. I know it was a lot of information in a short period of time. But the most important thing is you need to be proactive and plan now for this year, for 2022, as well as plan for 23 through 26, when TCJA, a lot of the provisions in TCJA expire.
That's right. Again, I want to thank everybody for joining us. And if you have questions, just reach out to Michael or myself. Our email addresses are at the end of the slides. We'll be posting this on our website in short order. So I thank you, everybody, for joining us.